And slideshow from the beginning.
Let's go!
All right, welcome everybody to another edition of Think with a Drink. This is the weekly webinar series brought to you by the ARIES Foundation for Financial Education. And this week we got a fun one because we are literally at the halfway point, Craig. It's literally tomorrow is the halfway point. It's June 30th. We're at June 29th. And so this is sort of a mid-year review. We're going to look at a little bit of what's happened, what's gone on. We'll sort of banty about our thoughts on different topics that have occurred this year. And then we'll sort of take a look at what's happened or what we see going to happen or what we think is going to happen or, God bless, who knows, going forward here with the rest of the year in sort of a, hey, one side versus the other. You know, one of us is Mr. Positive and Sunshine there, and the other one thinks we're going to hell, which, you know, is I sitting in that seat in terms of going through this. So you ready for this, Greg? You ready to get started?
I am ready. I am ready. Ding, ding, ring the bell.
All right, so we told you Think with a Drink is brought to you by the ARIES Foundation for Financial Education. We are a nonprofit. You can find us on the web at ariesfoundation.org. You know, our mission is trying to help everyone have a better relationship with their money, because whether you realize it or not, you are in a relationship with your money. And just like every other personal relationship that you have, there are behaviors and triggers and things that cause us to whack. Well, Craig and I like to say sometimes a little irrationally when dealing with our finances. All myself, Craig, the rest of the ARIES team tries to do is to take some of that emotion out of dealing with your money. My name is Tom Alessi. I am the president of the ARIES Foundation. I have been in financial services. I am coming up on the end of my 24th year. I am an investment advisor. It means I act as a fiduciary whenever giving guidance or advice to any of my clients. I want to bring in my co-part for this evening, the other side of the equation, Mr. Positive and Sunshine, my vice president. Craig, if you can introduce yourself.
Sure. So I'm Craig Richardson. I'm the vice president of the ARIES Foundation. I've been in financial services over 19 years. I specialize in working with families and individuals to help them define their financial goals and have a better relationship with their money.
And Craig will be chiming in as we go along through this, because this is more of a back and forth sort of give and take part of this battle royale. You know, one of the ones I gave was, are you ready to rumble? In the traditions of, you know, great matchups in history, you know, spy versus spy, you know, Tom and Jerry, Itchy and Scratchy, you know, so, you know, all those great duels and debates that have gone on.
Rock'em sock'em robots.
Well, Rock'em Sock'em Robot. I couldn't figure out how to do that. I did want to do it. I think that's a good one. We'll have to save that. So we call this Think with a Drink because really what Craig and myself and what we try to do with ARIES is try to make financial services, financial information less intimidating, I guess. I just saw an article, it was funny, the other day where they talked about, you know, take all the jargon out, please, because it's hampering people trying to save for their retirement, all the jargon that gets thrown around. And that's been our mantra since we started. It was one of the reasons we founded and started the foundation, was just for that purpose, to take some of that jargon and financialese and information out of the conversation. But so in part of Think with a Drink is that, you know, in trying to do that and make it more relaxed, make it more casual, we can't think of a better way to do that than if we have something cold to sip on. And this one, Craig, it's interesting. So this is Nightshift Brewing, their Nite Lite. But here's an interesting one for you. They've actually changed the look of the can. So
that's what it used to look like?
Yeah, no, this is what it looks like now.
My can's old and crusty. Is that what you're
Yeah,
telling me?
you've got, so I think this is, I honestly believe that if you go on a website, this is what you see now. I think this is
Oh,
in response to the whole Bud Light thing.
really?
I
Okay.
think they're trying to push this whole, we're a better light beer, basically, than what you're used to. You know, that stuff that they're giving away now. God bless Bud Light. You can buy an 18 pack of Bud Light and they'll give you $15 back.
It's almost like buying a case of water now.
Yeah, well, it's free. Literally, in some places, like they'll sell 15 packs for $15. They'll give you $15 back. I mean, it's free, basically. So it's free water. But yes, Nite Lite comes in about 4.3. It's 120 calories, so I don't know how that compares with Bud Light. I know that's right around what Coors and Miller Lite are, somewhere in that range, right?
Okay.
But, you know, this is a very, very crushable, you can have this any place, anywhere, anytime. It's okay because it's an easy drinking and better tasting light beer. And light beer is generally, when we're talking about summer fare, certainly, you know, seafood and stuff on the grill that's light is certainly an easy pairing for that. And you're holding the same. This is the old Owl can Nite Lite that we've got.
There's 120 calories on this, but I got a giant ass can here, so
Well,
it's 1 pint, 120 calories.
all right. So I think it's 120 calories per 12 ounces.
Oh, okay. I didn't say that. I'll have to reread it.
Because I think that's what it says on the can. All right. So we're going to get started here as Craig tries to fight through figuring out how many calories there are in Nite Lite.
I'll have to go running after, that's all.
All right. So here's our agenda for tonight's show. What's happened so far? How do we feel about interest rates, inflation, recession? And then what to watch for, or what do we see or think where things are headed, or what's going to happen here for the next 6 months? And then a little bit of follow-up is maybe some of the things you should be thinking about doing. So we're going to start, Craig, with a one-word response from you. 2023 has been blank.
As well, one word response, expected.
Expected. And why is that?
Well, because I think, you know, a lot of what's been going on this year, we've been waiting to see happen for a while now, right? 2022 was really the push over the edge. And then, you know, 2023 is kind of what was expected after 2022 happened. So I think it's expected, not predictable, but expected.
Well, see, that my word is predictable. That's what I had. I had predictable.
Okay.
Yes, because it's very similar in terms of our logic and our thinking. See, we're right on the same path with this. That, you know, the idea there that 2022 was so bad that, of course, 2023 was going to seem better. It was going to pick up. It was going to be in a better place just because 2022 was so bad. So that's why I like yours though, expected. Mine I had was predictable. That's what I had for that one word response.
Well, as a financial advisor, I like to leave predictable out of my vocabulary.
Along with that guaranteed word. All right. So 2023 so far. So here's the first thing we want to look at. We want to talk about, you know, the market. And if you can't really see that on the screen, that's somebody at an exchange place at a store, and he's trading in a bear and he would like a bull instead, basically, is what he said. Can I trade in the bear for a bull, right? So, you know, here's the thing with the stock market and what's going on, specifically when we look at the S&P 500. The S&P 500, what you're hearing right now as of last month and into June, is that we're up 20% from the low back in October, which technically, in a technicality, qualifies as the beginning of a bull, right? Like, so, hey, this is like the start of a bull. Like, you're trading it in. I'm getting my bull. The problem here is specifically in the S&P 500, it's all heavily weighted towards tech stocks and some larger cap holdings. It's like the Big 12. And then everybody else was pretty much flat up until last week, right, is what happened. Last week they started to get, you know, everybody started to gain a little bit of traction here. But overall, it's been technology driving this. The NASDAQ, God bless, is on they're going to have the largest first half of the year ever in that index.
Wow.
They are up like 52% this year.
Wow. That's
It's
great.
all based on tech. It's all based on AI. It's all based on all of that stuff.
Mm-hmm. So it's going to be like the next big housing bubble type thing, or the next big Bitcoin thing. Everybody wants to jump on the AI tech.
It's euphoria right now, which is exactly what happens. Like we talk about all the time. This is when everybody starts piling in when we get in a euphoria.
Mm-hmm.
With the market, let's remember the S&P 500, the high watermark of the S&P 500 was back at the end of 2021. It was 4768, something like that.
Yep.
Right. You know, today we closed out, I think we were at 4390 something, 94, 4394, something like that. You're still down over 10% from the all-time high.
Right. That's why up 20%, down 10%, all these numbers can be a little misleading because they're all relative to one another.
Yeah, it's sort of like, you know, it's funny, and they do this in baseball. It drives me crazy with baseball when they do this, because they'll talk about a hitter and they'll say, this guy has been the best hitter since April 20th, you know, not part of the season. Or like May 15th, this guy's hitting 425. I'm like, well, that's great, but that's not the whole season, right? You're picking a random date and time and saying, we're going forward from here. Now, in the case of the markets, they go on a 1 year time frame. That's how they sort of view everything. It's a rolling 1 year. It's like you said, I can sort of jump in at any point and look at where I am and say, hey, gee, the market low was back in October. I'm up 20% now. You know, things are going up. Everything looks great. I should get in.
Well, and that's why one indicator never tells the story, right? Because numbers are easy to manipulate. That's the whole point. I mean, I took accounting. I know all about number manipulation. I can make anything look like anything you want it to look like.
Right.
The issue, but you can't manipulate all the indicators. So you want to look at more than just, is it up 10%, up 20%? You know, what are you comparing it to, like you just said?
Right. You know, just be careful with that. We'll talk about that towards the end. And then the second one is the banks, right? So this was a big deal, you know, earlier this year in terms of what happened. You know, you had bank failures, you had Silicon Valley Bank, you had First Republic, you had Signature Bank. You know, these have created unease in the banking situation. You got people questioning the health of banks and whether or not it makes sense for them to have money in certain banks versus other banks. You know, where this heads, and we did that as part of the newsletter. You know, for those who don't get our newsletter, you can reach out to us at ariesfoundation.org. But we just did a whole thing on it. We weren't trying to rehash the problem with the banks. It's just right now, the big fear is commercial loans, specifically office building loans. Because these are going to, go ahead.
Yeah, I was going to say, you know, well, it did hurt a few. I think it helped many because I think it made the Fed put the brake a little bit on raising interest rates because they were worried about what the public was perceiving as an issue with the banks.
Right. And so, you know, and you're dealing with this commercial loan now, these defaults that are going to start to happen. And when that does, you know, it doesn't appear that a lot of regional banks are holding a lot of office building commercial loan debt, just by the nature of where they are and who they are, but you never know. And that could seriously impact, and you could see another failure if that happens.
Yeah, I think when we get towards the end, we're talking about forecasting. I got some comments around that.
Right. Okay. And then the last one is the housing market, right? Which has been, you know, I think somewhat dented, somewhat deflated. The wrecking ball hasn't hit it, you know, in terms of the picture on the screen there with the interest rates crashing into it. It hasn't hit, but it has definitely slowed the pace. I don't think there's as much inventory on the market today. And, you know, where that goes from here may not, you know, really recover until probably, you know, maybe the spring next year type of thing.
Yep. Well, I mean, I think the first thing is one thing that continuously pushes the housing market is people need a place to live. Right? That's not going to change. And the population's going up, not down. So the demand for housing continues to tick up, even though, like I said, interest rates and those types of indicators can change how the market fluctuates from period to period.
Right, about what is affordable, about where you can live, and then that becomes where can you be, and then now this comes back to the whole bank thing, because now it's like, well, I'm working for this company, but I can't go to your office. It's 2.5 hours away. I'm going to be remote, so that's part of some of this is sort of it all sort of connects when you start looking at the pieces to it.
Yep.
So now we want to talk about how do we feel about interest rates, right? So that's the Fed pausing interest rates after he's already constricted and squeezed the life out of the markets and everything. That's what the visual image is there, right? So right now, the Federal Reserve, the Fed lending, the overnight rate, Craig, right now is 5%. It's 5.07%. And for those folks out there, the Fed lending rate is that's what banks and institutions lend amongst themselves, right? So it's money that they can float back and forth. And when the Federal Reserve Bank increases interest rates, it causes this number to rise, which then directly impacts prime lending.
Right.
And the prime lending rate right now is 8.25%.
Wow.
Yeah.
Okay.
That's a big number.
Mm-hmm. Yep.
So here's the thing with interest rates. Most economists, most things that you read, most stuff that you see has said that the target that they believe that the Fed is going to hold the lending rate was between 5 and 5.25%.
Okay.
We're at 5.07 right now, right? So everybody sort of that was sort of the target. That's what everybody said. Hey, this is where it's going to be held at, in terms of it. The one thing that nobody says, Greg, in all of this is how long are they going to hold it for?
Well, that's the big unknown, right?
Well, so here's the thing. If you look back at history, right? Look back just recent history, not too long ago. In the 90s, it was 7 years.
Okay.
We went from 1994 to 2001 with the Fed overnight lending rate over 5%.
Right.
The last time it went over 5%, that was in 2006.
Mm-hmm.
And it held for 15 months until September of 2007, which happened to coincide and start the housing bubble.
Ah, well, yes, okay.
That was the only reason that the Fed even moved the rate, is because the indicator that housing was in a serious trouble and started to move the rate down. They did not go as quickly, but that's where it started. Otherwise, it may have just held. Like if nothing had happened in the housing market, it may have held for a few years at over 5%. So there's no indication from anything right now that the Fed is going to lower or cut the interest rate.
Well, for the minimum another 6 to 8 months, right? If you go by your last indicator.
Right. But that
puts us
puts us into
about a
2024.
year and a half ago.
Right. But that puts us into 2024, which is what most people right now. The Fed has their last meeting said no indication that they will cut rates in 2024.
Yeah, I'd have to agree with that. I don't see in 2023 anything coming down, and probably not until the second quarter of 2024, if not later.
Right. Sort of what that looks like.
Mm-hmm.
The next one is inflation. Right. So here's the thing. Currently, at the end of May 2023, inflation was at 4%. Right. Now, this is a much lower, than what we heard in March, where like 8%, or 7.9 or some craziness or whatever that was going on.
Last June, 9.1.
Yeah, 9.1, right? So 4% sounds a lot better, right? However, the Fed's target is 2 to 3%.
Mm-hmm.
So what happens if the Fed can't get this 4% to move? What happens if 4% ticks up next month or this month?
Well, I don't know that it will. I think part of getting ahead of myself in the positivity zone is that you're going from 9.1 down to 4. That's a huge, serious tick down.
Right. No.
The target is,
believe me, we'll get into it when we get into the where we see things going from here. But what I'm saying is the reason inflation is the worry and why it's been a worry and why it's been a concern is because that's what the Fed is basing it off, their 2 to 3%. And it's almost like if it doesn't move, like, you know, then it's like, who are you going to call, right? You know, the Fed busters. Like, what are you going to do here, right?
Right, but I think two of the bigger things where inflation has hit the most has been home pricing, which we just talked about, that's starting to get sluggish, right? And the cost of fuel, which has also been coming down.
Right.
So I think, like I said, those are the biggest portions of where that inflation number is coming from. And you're starting to see a little bit of movement on those because of the interest rate hikes.
Right, but where you're seeing it still stay high is in the cost of services.
Oh, sure, but I don't know if that's the whole leader as far as
Right.
pushing the fund number forward. So
yeah. You know, and then recession, right? So recession is knocking on the door. Look, God bless here with recession. I have no, you know, I'm still at this point, I'm almost throwing in the towel with this thing with the Fed and calling a recession or not calling a recession. I read in the last week, like 7 different economic forecasts that literally go in opposite directions.
Yep.
And they were talking, you know, Barron's and, you know, JP Morgan and, you know, all of these different economists with these outlooks that are like, basically, I don't know, you know, I mean, it's sort of what you're getting with this, like the belief, I think for most of this, and I'm not going to, you know, steal your, you know, rainbows and sunshine there is that, you know, that the only way this happens, a recession, is that the Fed causes it. Is that the Fed continues to push the button and raise interest rates in the coming months. That's going to push because right now the projection is that this quarter is going to end at up about 0.5, which means it's not a negative quarter.
Yeah, I mean, anyone to help your cause here, you know, the issue is that all the traditional indicators that we talked about earlier, they outweigh the negative indicators outweigh the positive indicators. And so technically we probably should be in a recession. But there's all the stuff that's going on that's atypical of what's going on in the market right now.
Right.
Right. Via, you know, consumer spending in the job market. So it's like it's floating, this whole thing. You've got some buoys.
Right. It's crazy. It just is like it shrugs it off. It's like, man, I don't care. All right. You know,
People don't want a recession. They don't.
Yeah, I don't want it. Get out. You know, I don't want to hear you. All right, so where are we headed? All right, so now I'm going to turn it over to you, Mr. Rainbow and Sunshine. Hey. I was going to do unicorns and show ponies for Scott Zolak there, but figured I'd do sunshine and rainbows. So tell me where you see the things going in the next 6 months.
So based on all the things we talked about earlier, like I said, interest rates are up, but if you look at where they were a year ago for home mortgage rates, you know, the average in June 2022 was 6% on a 30-year fixed. Right now it's 6.9. So while it's up, it's not off. It's not going off the deep end. So I like that, right? I mean, there's a bigger spread between the 15-year and the ARM rates from a year ago, but you know, like it's not a giant spread. I don't think you're starting to see it come back down a little bit, those interest rates, as opposed to going up because the Fed is kind of hedging their next increases. So I like that. The big thing I do like though is bank savings rates are like off the hook compared to a year ago. Like a year ago, you could get like 0.22%. Now you've got some out there in advertising 4.5%.
Right.
Well, that's 40 times, 20 times what it was a year ago, right? So those fixed rates, even though the Fed is pushing those rates up, those fixed instruments are becoming stronger. And so that's something that's been lagging for a long time. It's why I think the stock market drilled ahead as long as it did, because there was nowhere else to put your money. And now you got some choices. We get 4 or 5% predictable. So even if you have a 4% inflation rate, if I'm getting 5, I'm still staying ahead of the curve. So I like that. I think that's a good thing. Bond rates, you know, they're getting better too, right? The 3-month is 5.3 as of today. What I don't like though is you still have this inverse relationship going on with the 30-year being 3.9. But it's a lot closer than it was a couple of years ago. It was more upside down when we predicted there's going to be a recession because of the upside down nature of the market and, you know, the long rates versus the short rates. but it's closing the gap. And I think once again, we're going through this pain point where the Fed's raising rates to slow inflation, but it's working. It's actually working because those fixed rates are starting to come back up. So I like all that. Like I said, we talked about inflation earlier. I think, we went from 9.1 as a high last June to 4%. So that's coming in the right direction. And as we saw, some of that is indicated by the housing market, which has kind of slowed a little bit. So I think you're going to see some of that inflation even tick down a little bit more. Will it hit the Fed's 2% goal? I don't know. But if we can get into 2, 3, 3.5, I'm pretty happy with that. I think that's a good indicator. Now, the big thing, though, is like we just talked about, even the price of eggs is coming down. I checked that. Yeah, the price of eggs is down like 18%. So that's good. I can buy eggs now. Don't have to rely on my ducks anymore. It's great. Now, we talk about recession. That keeps coming up. Are we in a recession? Is it a recession? Is it going to be a recession? We just hashed that a little bit. But what I found is that we technically were in a recession in the first half of 2022 because we had 2 quarters that were down consecutively. However, 2022 finished up 2.6% in GDP, gross domestic product. So technically the 2022 was not a recession because we finished up for the year. So, we're going to hit it in 2023? I don't think so. And I think the big part of that is because consumer spending is up, the job market is up. And like I said, in May, there were 339,000 new jobs created by employers.
Right.
So, like you said, they're shrugging it off. They just keep marching forward. And, and I'm talking to lots of people who aren't just, getting jobs, they're getting raises in the jobs that they currently have. So, you're seeing some of these corrections happen within the job market and workforce itself. I think the biggest issue right now is that we just can't fill all the jobs. I think if we could fill all the jobs, I think we'd be bold. I think the market would be coming back. I think we'd be running right now. I think the issue there is trying to fill those jobs. So I'm pretty positive. I think, like I said, I think the outlook is, we've been crawling along. I think we've gotten some tick up in the markets, and I think people just don't want to see it slow down. We're going into an election year. We'll see what happens with that. But
we're doomed. Sorry, we're just doomed. Right? There's nothing good here in terms of dealing with this. So exactly what you were talking about and what you were saying is where I'm going to lead off. It's like I'm going back to inflation because this is the driver for the Federal Reserve Bank. If inflation does not come down, the Fed has only one hammer to swing, and that is interest rates. And the Fed has shown and has told you we are swinging, we are going to do it. And they are willing and are going to, probably in September, raise it by 25 basis points, and probably again in November. They will raise it again. They'll raise it 2 more times here as we go forward this year. And the whole thing is right now, everything is sort of saying, okay, it's going to be 25 basis points. But what if we tick up? This is what I was saying to you is what if 4% becomes, 4.3 in July or 4.5 in August? The Fed is not they've shown to go a 0.5 point. And in which case chaos will ensue, right? Because the market is not prepared for it. They really don't want that. The more economists are projecting a rate cut than anything else this year, which I don't see it as we talked about. Neither one of us feels as a reality at this point. That just does not seem anywhere in the world or vernacular for any of this. But I think that's going to be a driver for it. What I see, though, is it's sort of to slide into the sunshine and rainbows, a mild dip, right? So a dip of probably, maybe at this point, 5-8%, something like that. We're at 43 in the S&P 500. Maybe we go back down to like 39. But if you look at the history over since October, we've sort of been in that trench for a while. We were in the 39 to 42 trench for a while there. We broke out recently this month. But like I said, I think that had a lot more to do with certain specific companies than the whole broad-based market itself. So does that suddenly turn around now and say, wait, everything comes back to roots, like we talk about, everything comes back around and you got to sort of pay for this when you're dealing with it. And that's going to be tough. And then what happens if we do get another regional bank to fail? And all of a sudden that preponderance of fear and panic sets in again. And then what do we do? So there's a lot here that gets sketchy in terms of what's happening. I mean, I'm more positive on the outlook for 2024 than I am for the rest of 2023. I think, you and I've said it all along, I think we're in a recession. It's just the job market and the market itself has just been, shrugging it off and being like, man. But remember, the job market's a little weird indicator, and I understand the whole reason that they use it and go through it. But it's only people who are looking for work. Anybody who's been out of work for more than 2 years doesn't count. You get pushed off to the side. You're no longer counted on the roll anymore. So again, like you said, it's statistics. You can manipulate the numbers any way you want to make it look like, okay, things are more positive than maybe they actually are in the great grand scheme of everything.
Yeah, so the only thing in rebuttal here is that rebuttal is that, well, is inflation high? Yeah, but we have 10 years of no inflation. So let's be honest, if you average this out over 10 years, it's not high. And if you go back to
the Fed doesn't care about that. The Fed honestly doesn't care about the average.
I know about the real value of my money. And over the real value of my money over 10 years, it hasn't been a giant inflation jump, right?
But the Fed doesn't care about that. The Fed only cares about where it is today.
I understand that.
That's what they're going to base everything on. But yeah, I agree with you. Like, look, money was free. That's why everything happened, right? You had all of these companies and loans and all of this stuff because there was very, very little, like you said, fixed instruments were paying nothing.
Yeah, I mean, I remember like when I bought my house back in 2000, 2001, whatever that year was, I paid like 8.5% interest on the house. A few years later, I remortgaged and I'm down at 3.5%. So once again, I don't see a doom and gloom because even though you lived through the 70s, I lived through the 70s, double-digit inflation and double-digit mortgage rates, 12, 13%.
Yeah, that was the 80s. That's okay. The 80s.
Oh, okay. Well, yeah, okay. 70s and 80s, we had huge inflation. So
the overnight Fed lending rate, the highest it ever was in the early 1980s. It went to 19%.
So that was doom and gloom. That's craziness.
Right.
I think we survived COVID. We got through that. I think we're trying to now be productive. I go out on a Wednesday night and the restaurants are packed. People are spending money like they're not afraid. So
we're going to talk about that in a second. I'm going to wrap this up and move us on.
Okay.
We'll talk about that. Right. In terms of, the question we keep getting asked is, what should I be doing or what should you be doing? Right. And so just to that point there, one of the things is spend more money. But we don't mean spend more money like Craig's talking about, going out and blowing it in a restaurant. We're talking about buying, like if you're a participant in a retirement plan, have you looked at what you're contributing? Or if you're trying to save, are you looking at what your saving rate is? Because now would be the time, if you're an investor, if you're a bull, if you're like Craig and you think, hey, this stuff is all going to just start turning around and going up from here, I should be investing more, spending more money in that situation.
Mm-hmm.
If you're more of a bear, then it might be, well, okay, wait, I'm getting, as Craig said, interest on my fixed money in the bank. I should be taking advantage of that and putting money into the savings accounts because I'm now getting actually return on that.
Mm-hmm. Should
always be reducing your debt, right? That's something that everybody should be focused on. And we've had plenty of stuff in our library and, you can always reach out to us for any help in terms of dealing with that, especially if you got student loans and they're coming up in October. Reach out to us. We're happy to have a conversation. We'll give you how to do that at the end. But, we have a lot of conversations about that. And then always protect what you have. And protection isn't just protecting what's there, what's in the bank, or what the interest, or the investments, but it's also protecting you and your family.
Absolutely. Yeah. And you know what, Tom, what you're talking about here is not market sensitive, not timing sensitive. This is just basic planning 101. Do I have enough cash reserves? Have I protected what I have? And do I have an automated savings plan? So I make sure I've got people that some of what I have. It's not how much you make, it's how much you keep. Whether
Right.
you or not, right? So even if you're spending money, it's all about balance. So this is nothing that has to do with, how the market's indicating. These are just
Correct. Right. That's why we keep getting asked it, and it's always the same sort of refrain. This is what you should be doing, regardless of what's happening, whether we're going up, whether we're going down. This is how you should be dealing with things.
Right, because we're trying to keep you from being Chicken Little.
Yeah.
Right? Don't
And
be
to
chicken.
that end, right, you should be thinking of this as when we say due diligence about asset allocation, this is about thinking about where you're putting your money, whether that's in the bank, which bank you're putting it in, whether it's investing, what you're investing in. God bless how many people we run into with question, like I got into crypto and I had no idea what it was. Still can't explain what crypto is, but I invested in it just because everybody was doing it.
That's a little bit different than poor allocation. That's not doing the research.
Well, that's due diligence. That's the whole idea of doing due diligence of where you're putting your money, but also on how you're allocated, right? So this comes back to a lot of times we sit down with employees in retirement plans who've never really gone through and looked at what their allocation strategy is inside. Right. A lot of times it was just somebody helped them and they did it. Now it's 10 years later and nothing's changed.
Right. Just remember too is going back to the crypto thing. For every story where someone got rich quick, 100 people got poor quick. So you get
that's like the casino. Like hey, they show you the guy who won on pulling the slot machine, but the other 40,000 people who got lost all the money in the stupid thing. You don't see their picture.
Yeah, you don't hear those stories, right? Yeah.
All right, so steps you can take, like we talked about. A bull would be somebody who's, not to say sunshine and rainbows like Craig, but more positive, more see this in a growth situation, see that the markets and opportunity are here, that it can grow, right? So that would be investing more now. That would understand that you might want to be looking in today's market, like we talked about, from now until into 2024, just because of what's happened. And you should be rebalancing on a regular basis because you're probably, and rebalancing means you selected a portfolio of, say, 4 or 5 holdings in your retirement account. And let's say we just had 5 and they were 20% each. Well, you just want to make sure they always have 20% each because otherwise you're getting out of balance.
You want to manage your risk. Absolutely. Yep.
And then a bear, that would be somebody who sees, like my side of the table, that things are not as rosy and sunshine as they are out there and might be just a little bit skeptical in terms of what's going on. A bear might be more of a buy and hold. Whatever I buy today, I'm not going to worry about it for at least a year or two, right? So I'm not really going to be thinking about it. I'm going to be holding that. I'm going to be using more index funds because I'm not going to get swept up in this whole, crypto, and that's the due diligence thing. And it's a passive investment. I'm just going to put the money in and not really think about it. But always think about dollar cost averaging. And dollar cost averaging just means you're buying as things go along. I buy on the way up. I buy on the way down. I buy, and as things happen, because that allows me to take advantage of swings in the market without trying to guess when they're going to happen.
Right. Consistency is key. Right.
Absolutely. And that's what retirement plans do for everybody. So one of the reasons they create wealth is because it does it for you. It goes in on your paycheck as it goes along. That's the thing. It's a very consistent model. That's a great tool for wealth building.
Yep.
All right, for any of you out there, any of the stuff that we talked about, any of this, we mentioned a couple of different things out there that you might have some, questions on, confusion about, want a little bit of clarity, reach out to us. That's why we're here. That's what we do. You can always book a time. You can see the link is there. You can always shoot the QR code. It'll open up our calendar. We're happy to schedule a time with anybody and just have a conversation about what's important to you. And Craig, we are going on break for this summer. So it's a happy 4th of July to everybody next week. We're going to go on a summer break. We're going to come back in the fall. We're going to come back, more content, more guests. Hopefully podcasts will be set up for us as well. We'll have that all in place. But that's generally the idea for everything. But if you ever want to reach us, again, you can always go to the web. It's ariesfoundation.org. You can email us info@ariesfoundation.org, or just easier, just shoot the QR code, set up a meeting. We're happy to have a conversation with you. And on that, Craig, I'm
Go down
going
to
to
the
say, what happened?
So, or you can go down to the Cape and Tom will wander around on a beach somewhere. That's fine. You can find him down
Yeah.
there too.
That's the idea. All right, I'm going to say Skull.
Go.